As the Danish philosopher Soren Kierkegaard noted, life can only be understood backward, but it must be lived forward. The stock investor is neither right or wrong because others agreed or disagreed with him. He is right because his facts and analyses are right. But the intelligent investor has no interest in being temporarily right. To reach your long-term financial goals, you must be sustainably and reliably right. Those who do not remember the past are condemned to repeat it. Operations not meeting these requirements are speculative. After all, the whole point of investing is not to earn more money than average, but to earn enough money to meet your own needs. In the short run, the market is a voting machine, but in the long run, it is a buying machine. The intelligent investor is a realist who sells to optimists and buys from pessimists. But investing isn't about beating others at their game, it's about controlling yourself at your own game. The individual investor should act consistently as an investor, not as a speculator. Americans are getting stronger. 20 years ago, it took two people to carry $10 worth of groceries. Today, a 5-year-old can do it. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. The future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. People who invest make money for themselves. People who speculate make money for their brokers. The readers to buy their stocks as they bought their groceries, not as they bought their perfume. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Before you invest, you must ensure that you have realistically assessed your probability of being right and how you will react to the consequences of being wrong. While it seems easy to foresee which industry will grow the fastest, that foresight has no real value if most other investors are already expecting the same thing. The punches you miss are the ones that wear you out. You must deliberately protect yourself against serious losses. You must aspire to adequate, not extraordinary performance. Abnormally good or abnormally bad conditions do not last forever. The intelligent investor dreads a bull market since it makes stocks more costly to buy. While people were drowning in data, knowledge was nowhere to be found. Intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn. You will be much more in control if you realize how much you are not in control. Since the profits that companies can earn are finite, the price that investors should be willing to pay for stocks must also be finite. All things excellent are as difficult as they are rare. The investor's chief problem and even his worst enemy is likely to be himself. The heart of Graham's argument is that the intelligent investor must never forecast the future exclusively by extrapolating the past. High valuations entail high risk.